Manish Gunwani joins us now. It's been a while I haven't interacted with him, so let's connect with him to understand what he makes of the current market setup. He bought a lot into hotels and hospital stocks in his previous avatar. Is he doing the same or has he identified some new trends? Let's discuss all that and much more with him. Manish bhai, so good to have you back. Thank you for joining us.
Hi, Nikun. Thanks for having me.
So where do we start with? Your great call on Tata Group, hotel stocks, and hospital stocks, or we should simply talk about the big picture first?
No, I think the new themes we are more positive on, which are basically things related to power capex or revival in rural consumption, pharma. So these are the new set. The ones you said are a bit old right now.
39. Okay. So let's understand where we stand. And I'll just put this sheet out. And this is a pure, very basic sheet. You look at much more sophisticated data here. But this is the P multiple of the small cap index and the large cap index. When I say large cap index, Nifty. The premium between the small cap index and the mid cap and the small cap index and the Nifty is almost equal now. And small cap indices now are trading above their 5-year average. So do you think now, forget amber light, it is red light for small and mid cap stocks now?
No, Nikun. Actually, I do think that while obviously small caps tend to be volatile, on a 2-3 year basis, that is where the big return will be made. The big picture, as you said, I have is that we are living in times where I don't think you can be very bullish on global economic growth because China seems to be structurally slowing down, US likely to go into a cyclical slowdown over the next 1 year or so. Japan, China, Europe, we all know that they seem to have big demographic and debt issues. So if we are living in a time where global growth is low, but I think liquidity will be good because frankly, I think the debt levels in the world are such that you will not see very high real interest rates in most economies. And my hunch is that a lot of the Western central banks will also become dovish a bit earlier than people expect. In which case, if you combine slow global growth with good liquidity, with the fact that India seems to be having a superb relative position within emerging markets, then what will happen, I think, is a lot of the mega caps will struggle to grow because they need global growth and domestic growth to fire the industry growth because the mega caps, by definition, cannot outperform the industry by too much. And I think a lot of the smaller companies will, if they have a good business model, good management team, if they are on the right side of tech disruption, or if they're part of a global theme, I think. So I'm not necessarily saying that the entire small cap index will do well, but I'm just saying that unless we have some exposure to small caps, I think it will be difficult to generate high returns.
Why are banks not participating? That's one sector where you can see like you have a 6x6 visibility for next 3-4 quarters and the markets are just not rewarding them.
Yeah, we're also sometimes breaking our head on this. But I think the logic is actually that if you believe in reversion to mean, first of all, the ROA of this industry today is at its peak, all-time peak, right? So if you believe in reversion to mean, the first thing is something may go wrong. And the second part is if that's something which is going wrong, where is it likely to be? I think it needs to be in retail lending, right? Because most of the big banks have moved away from corporate lending. The entire growth has come from retail and to a certain extent SME lending. Now, if you believe that the next down cycle in credit quality is going to happen in retail credit, that is the only perspective from which you should be concerned about banks because I guess growth and valuations are fine at this point of time. But I think the subconscious thought maybe apart from the ownership angle, that obviously these are very well-owned names. The fear I think at the back of every investor's mind is this is too good to be true, and when the next cycle comes, unfortunately, I think there will be no hiding place. So if you see the previous cycle, when the corporate loans went bad, we had a set of banks to hide in, which were predominantly retail banks. But I don't think that if there's a broad-based downturn in retail asset quality, apart from some very niche NBFCs maybe, I don't think there will be any place to hide in this sector. So I think that's somewhere playing on everyone's mind.
Sure. Manish, what's happening within the big boys of the private banking world? I mean, we've all seen stark underperformance from an HDFC Bank, which I think has lasted over 30 months now. We were just looking at Kotak valuations, which are now lower than ICICI Bank. I mean, in the past, Kotak has always been at a premium to ICICI Bank. That's clearly not the case. ICICI Bank seems to be the only go-to, and rest all of them have been underperforming. Why is that?
So two things here. First of all, as I said, if your fear is retail credit going bad at some point, then there'll be a kind of homogeneous pain across the sector, in which case the logic would be, why would you be in a high price to book bank? The other thing is, obviously, a lot of investors were underinvested in PSU banks or NBFCs, which were like below price to book because of a lot of exposure to infra or corporates. And now at this point, actually, if you see the ROE of maybe the top 10 lending institutions, everyone's ROE is broadly the same. I mean, someone would be at 14, someone would be at 18, but there's not so much of differential in ROE. I know this is not sustainable. As I said, the ROA of this sector today is probably higher than 2010, which was the previous peak. But the simple point is the valuation gap between the companies which are around 1 time book and 2.5 time book, at least optically, sometimes it's difficult to justify because the ROE convergence has happened. Now, if the ROE diverges again in future, obviously, you could say that the large private banks will start outperforming. But the trillion-dollar question is, when does the ROE divergence begin again? Because at this point, the feedback from the ground seems to be that retail credit quality is still holding up. So in that scenario, I think people are kind of flowing to the cheaper banks rather than the higher priced book banks.
Let's also get in a sense as to what the outlook is when it comes to the rural economy recovery going forward. Do you believe that we are likely to see a private capex pickup, that the festive season could bring cheer for companies that are closely linked to the rural economy, and that could be a big booster shot?
Yeah, so I think medium term, the rural economy should revive. Whether this festive season or not, I'm not sure. But I think the simple point is, if you see since the COVID, we have seen very weak rural consumption, and that is clearly because COVID and inflation, the twin shocks hit the balance sheet of the bottom 50%. And it takes time to recover. So the recovery process is on. Jobs are back, a lot of construction work is back, food prices are okay. But I think the balance sheet repair is taking some time. Second is that we have a fairly heavy election calendar ahead, and that helps. But having said that, that doesn't mean that you need to be in very penetrated consumer goods stocks, which are at 50, 60p. So I would say two-wheelers and microfinance probably are better ways to play rural rather than FMCG.
Manish, if the starting point is today, which is 18th of October, next 3 years, what should be a projected return according to you, based on the starting point and the view on earnings?
So I think the large cap index should do somewhere low teens, and I think the small and mid cap index should do a bit higher than that, my base case.
Small cap can give better returns from large cap, even though starting point is today.
That's a okay. I'm just saying that if you have a universe of good 30, 40 small caps, that will do better. The small cap index is a bit dicey because it tends to have 150, 200, 300 stocks. But I do think, as I said, that unless you have some small cap exposure, it will be difficult to create a big return.
Could you give us a flavor of what exactly do you like in small cap? I mean, in terms of a theme, without getting into an individual stock idea here, can you give us a sense of where you think there is a nice, clear visibility based on the current framework?
Yeah, so a lot of the 3, 4 themes we mentioned, but basically, I think, for example, if you see this whole power capex segment, it has a lot of legs. There, domestic, there is a demand supply gap. There is a big global cycle, which is basically the transition to renewables with upgradation of the grid in almost all countries. And there's a China plus one angle also there, that if the Western countries have to do this transition, at the same time, they're not wanting to buy too much from China, which leaves India as a big potential supplier. So you have good tailwinds on that power capex value chain. Even in financials, I think will be a reversion to asset quality in the microfinance space. Also, the smaller banks, even if they are expensive, I would probably tend to prefer them over the big private banks because, as I said, I'm not very positive on global growth or even India growth going back to 8-9%. So if you're not very positive at a macro level, you're better off buying a bank which is 0.2% of the system can become 1% of the system, rather than buying a bank which is 10% of the system, because I don't think it can obviously become 30% of the system. So to that extent, because as I said, the macro growth is limited. In a lot of sectors, if you can get a good management team and a good business model, the lower base, I think, will help. The third is basically in pharma also, for example. I think there are select mid and small caps which have got beaten down over the last 3-4 years because either product issues or FD issues. So there is a host of mid and small cap pharma names which make good risk reward as well. So I think there are a lot of these segments where, given the low base of the small caps and the fact that some of them may be on the right side of disruption, right? So there are good optionalities in some of these small caps which are in EV, which are in OTT, QSR also. So I think a lot of these high growth segments, unfortunately, are very small at this point from a economic angle, in which case you will need to be in small caps to play these high growth segments, because honestly, I don't think there is growth in big segments right now, and I don't think it's likely next 2 years.
Let's also get in a take as to how you're looking at really playing out the entire manufacturing theme, and where exactly do you believe that there is opportunity within this space?
So as I said, chemicals is where the China plus one thing has played out, with the stocks right now. They are going through a bit of a earning issue because globally demand is low. And because they've done well over the last 8-10 years, I think the stocks are expensive. So personally, I'm not very bullish on chemicals. But as I said, this entire power equipment value chain, which is transformers, substations, cables, windmill equipment, and all that, I think that can be a very scalable opportunity if we play the cards right, because it's very rare to see almost every country do capex in one segment at the same time. So because of climate change and geopolitical considerations, you are getting a phase of maybe 10 years where almost the entire globe is transitioning to renewables at the same time. Um, Obviously, that can be a mega opportunity. So in that sense, I think we need to see, obviously these stocks have done well, so they're no longer cheap right now. But all these stocks on transformers, power wires, cables, etc. I think the opportunity space seems quite high. So they may go through a sustained re-rating as earnings keep flowing in.
Sure. Manish, great to have you on the show and getting all that insight on the markets and, of course, how investors should be approaching their portfolios.
Thanks a lot.